Hi, and welcome back to the WHVP podcast. In this episode of the podcast, the WHVP team sits down to discuss risk management. We start the episode off by discussing the news of the new Swiss president. And then we'll jump into the topic of risk management with a quick definition of risk management and a definition of systematic and unsystematic risk. We'll then talk about the approaches to risk management that can be taken, or the due diligence of risk management for an investor. Finally, we'll talk about professional investors and private investors and how they can use risk management and what the differences are. Now, let's get into it. So, back in the office again. Jay Monroe, how's it feel to be home?
It feels great.
Yes, definitely. It was great to being traveling, but it's also great to being home and enjoying the holiday season in Switzerland with our family and friends.
Yes, absolutely. We already had our holiday party last Friday, so that was very nice. It's very nice to be able to do the podcast in the same room again, not to worry about the connection issues, and of course it's great to catch up with the whole team and to be here again. But I have to say, even though I really much enjoyed, I'm already looking forward to going back to the US again next year. So I like the traveling. When you're like traveling, you're looking forward to get home, and when you're home, you can look forward to the traveling. So all is good.
Yeah, so you will travel in January already again.
Yes, if everything stays the way it is right now. Switzerland just introduced some new measurements, like how to get into the country, which we were affected by as well. So if everything stays stable and goes as planned, then I'm going back to Florida on January 7th. So that should be fun.
Yeah, it's exciting. And following up on that, I mean, we are super happy to have you guys back in the office. We miss you guys deeply. But going further, there's big news. It's not usually as big news when the United States gets a new president, but there's the announcement that Switzerland will have a new president.
Yes, that's correct. Starting from January 1st, Ignazio Cassis from the Italian-speaking part of Switzerland will be our president for 1 year. I think it's the first time in like 24 or 25 years that someone from the Italian-speaking part was voted into this office, but I have to say it's really not that big of a deal in Switzerland. When we just briefly talked before we started, I said this is the first time I've actually really looked into this, because usually if you would ask people in Switzerland who the current president is, I would say the majority of people wouldn't know. Because the way it works in our country is we have like this federal council of 7 people, and them getting elected is quite a big deal. But once they are in the office, they just switch the presidential seat every year, and it starts with the most senior person being elected president, the second most senior person being vice president, and then after a year the vice president becomes president. And so the whole vote is more of a formality. There's no race, there's no publicity, there's certainly no debates. It's really just the parliament voting, and in this case with Ignazio Cassis, the vote was quite tight, but he was still accepted with I think 75% of the vote. So, but that's like a bad result, and the reason he got a bad result is because he was responsible for the trading negotiations with the European Union that didn't really end very well this year. So I think the negotiations were stopped because they couldn't really find enough common ground, and people were upset about it because he was. So every one of those 7 people in the Federal Council are responsible for one department, and he was responsible for the Department of Economics. And people were not really happy with how he led those negotiations, so they showed it by not like voting in with a super high percentage. But I would say 75% is still okay. And another interesting thing is the new vice president is Alain Berset, and he's a person that is currently extremely well known in Switzerland because he's the head of the Department of Health, meaning he's the poor person that has to announce all the measurements and all the corona-related problems and issues that we have to discuss. And he had a lot of, I would say, exposure to the public in the past 1.5 years, which is very unlikely for a Swiss politician. They don't usually are very much in. I'm not sure if it's right to say they're not in the public eye, but it's not so much a public discussion what they're doing on for regular people. But now with all the press conferences that we've had, he's an extremely well-known person. And extremely controversial as well, because that just comes with the topic. There's people who love him, people who hate him. Some say he does too much, some say he does too little. I'm sure it's similar in the US. So he is now becoming the vice president of the country. And they will be there for a year. So that was a very long monologue, but I think it was interesting this year because there were some of those specialities that we don't usually have.
Yeah, that's good. I learned a lot too.
just now I learned a lot.
No, I can totally agree with that. Mostly you're not that much aware of what these people are doing in their day-to-day business and how things are going, and the presidency, that's really a formality as far as I know, so that we have one specific person that can represent Switzerland when there was a very important event what is G16, G8,
Yeah, or also just meeting with the US president.
G7, G20, that's alright.
I think 2 years ago, the Swiss president met with back then Donald Trump, and that was a very big deal. And if you meet with someone that is representing such a huge nation, they want to also meet with someone that has a similar title than themselves. So
yeah, it's the 1 year. It's kind of the diplomatic head. It's your poster boy for or girl. True. Does Switzerland have a female president?
Yes, I think so.
Okay. Oh yeah, true. Actually, yeah.
Yeah,
it was. I think it was fairly recently, wasn't it?
We had even a female majority in the federal council for a couple of times, where we had 4 female and 3 male members. Yeah. I think generally, Swiss politicians are extremely low key. So it wouldn't be a very big deal if someone from the federal council takes the bike to work or takes public transportation to work. So they are not those celebrities. They're just living their lives, and people don't really care that much.
Yeah, I remember when Uli Muir, who met Donald Trump, when he was president, he comes from a village near where my in-laws grew up, and he just organized a hike, and whoever wanted to come from the village on a hike went on a hike with him.
I think
he's. But he is quite famous for being very open to the public.
Yeah, I think your mother met him a year ago or so.
Not even,
or this year?
This summer.
Because your grandparents are from the same village as he is, and he's very connected to...
I think she even went to the same school with him.
Yeah.
But
well, so anyway.
Zurich Oberlander, huh?
Yeah.
Hey.
Well, as interesting as it may be, I think we should head into the main topic. We're not political commentaries.
Correct. Yeah. But it's interesting to learn a little bit more about Swiss system for sure. So today we're going to be talking about risk management. Overall, what that is, we're just going to cover it very briefly. You can go. This is a topic where you could go for hours and hours. So I'll just quickly cover the definition of it and the 2 types of. I guess the 2 umbrellas of risk that we kind of look at, and where we can go deeper, and then we'll kind of move forward with further topics from there. So risk management is essentially when an investor identifies risks that have to be taken in consideration for any investment. You can kind of break this down. Often it's referred to as the risk reward I wouldn't say ratio, but risk reward benefit of an investment. How much risk do you take on for the reward that you want to get out of it, and how can you minimize that risk? What steps can the investor take to minimize that risk while maintaining a higher reward benefit and taking on less risk? So risk management essentially just is look at the risks that are potentially there. Do they have to be accepted risks, or can there be risks that can be somehow managed by my actions to reduce their effects on my investments or my portfolios? So in general, you have 2 kind of categories of risks where all the minor category of risks fall underneath, and that's systematic risk and unsystematic risk. And so systematic risk essentially is this is the probability that a loss will occur to the entire market or a segment of the market that you kind of have no control over per se. So for instance, this year or last year we saw coronavirus hit. That hit the entire market. That was a systematic risk that affected everyone everywhere around the world. And a kind of a repercussion of that we could say was also a systematic risk is the bottlenecking we saw of the Everglade ship that got stuck in the channel in Egypt, and then the continuation of that of outside of the port of LA where they have 70 plus ships just sitting waiting to get in. So those are things that are kind of systematic risk that that hit the broad market and hit a sector of the market. Obviously those shipping containers, they hit a lot more sectors of the market with things being delivered. But those are systematic risks that you can see potentially being a problem, but you have no control as an investor to really do something that's going to reduce the risk of that. If that happens, how it's going to affect your portfolio. So that's systematic risk. Unsystematic risk is things that you can look at more in a sector of the market or a company, and those are things like how the business is run, what are their financials, how do they run their company, what's their operation like, what's their strategic setup, and what's the legal and regulatory framework around that industry, around that company, and those all come with risks. And so how can we reduce those risks but get those rewards? And that's where we can take steps as investors to do research to look at what level of risk we can take. Now, in that you can also look at segmentations of the markets or sectors, and that's where you can use diversification to reduce the risk. As an example, you don't put all of my money into one company that I think has a potential for high reward, but I ignore the risks of their high debt levels, and then they go broke and I lose all my money. I only get a certain percentage back. So you can diversify by investing in 30 companies or 25 companies, whatever, so that if one company, I want to get the potential reward from that company, but I invest in other segments of the market, other companies, so if that investment does fall through, I still have other performing investments that will cover the risk of loss in that situation. So that's just kind of the quick overview. It's not deep, it's very shallow, and maybe we can go deeper into those topics a bit.
Yeah, I think for me the most important thing is for every risk you need to be rewarded, right? And for the systematic risk, because you can diversify it away, there's no reward for that risk. So if you do not use diversification to the ideal extent, you will have risk in your portfolio that there's no reward into the market. And I think there's varying opinions on like how many titles you need for there to be ideal diversification. Back when I was studying, I think what we learned was that the minimum is 15. When I looked into this topic, I saw that the average is, or what like the general opinion is that between 12 and 18 titles diversify away 90% of the risk. So I think if you have 20 plus minus titles, you should be fine. But what's extremely important to know there as well is, and that's something that a lot of people forget, is that there's costs associated with trading, and there's also costs associated with over diversification. So it very much depends on what your level of wealth is and whether or not direct investments in those titles make sense. If you're like, a young professional or a student that just starts with investing, it might make more sense to go with an ETF or a fund or something like that, where you have a product that is already diversified in itself, because you may not be able to afford to diversify your portfolio sufficiently with direct investments based on the size of the portfolio in regards with the fees, if that makes sense. I think that's for me the core piece that people should take away from our discussion with systematic and unsystematic risk. Of course, you could go on for hours, but I think that's what it comes down to.
Yeah, and I think there's a point to say that there's also debate on people who say you can diversify systematic risk versus you cannot diversify systematic risk, and I think it's important to say there's a level of systematic risk that you can diversify away. something like the coronavirus pandemic that no one saw coming, it hit all sectors of the market. So it's important to see if we weren't in the shipping industry or we were in industries that didn't rely on the shipping, that bottlenecking, we can diversify away from that to plan for that type of systematic risk. So I think you can't put as an investor, when you walk away from exactly what Jamie said, because she had made really, really good points, you can't walk away that every portfolio will have risk to some extent.
That is a really good point, what Jamie also said about starting young, because a very important point to take into consideration when taking on investment is a time horizon, because it has an influence of how much risk you are able to take in.
Yeah, I think that's a good point. It's often in risk appetite has a lot to do with the time horizon, or your risk tolerance has a lot to do with your time horizon based off of the loss you can take. You're much more able to take a loss when you're in your 20s versus taking a loss when you're in your 60s right before retirement. So I think that's a very good point. We're going to get into how to manage risk now, and maybe you can take over from there.
Yes, managing risk is very important since, as we just said, it's important to take into time horizon. So there are different instruments you can take on to manage your risk. So of course you can just say, okay, I'm not willing to take any risk, and then you will not be able to make any investments. So you just take any very, very low risk, for example, just cash, or maybe government bonds.
But sorry, I don't mean to interrupt, but what's also important that people understand is even those things have a certain level of risk, because what we see now with inflation is, you can have your money in a bank account and it might be safe, but inflation can eat it away, the bank could go bankrupt. So I think there's really no completely risk-free way of keeping your money.
Right. That what was the direction I was planning to go.
Sorry.
No, but it's totally fine, because it's really difficult to talk about no risk, because living is risk per se. So that's mostly not really an option, to have no risk in your life, and having no risk, especially if you have wealth. Then you can, as we have talked about, do it with diversification, that you minimize your risk, that you have different investments that might not be related to each other. So if one investment or one sector goes down, that the other one will stay stable or will even benefit out of it. Or what you can also do is to transfer risk to another party, which we see with insurances. So for example, if there is a storm, as has just happened in where was it, in Kentucky, that you insure your house, that you insure your belongings, and that is something which a lot of people do, but which people also have to be aware of, that it comes with some costs. So that there are some costs that are costs for this insurance, so that someone else takes risk. Of course, you can minimize this cost if you say, okay, there is a certain amount of money I can bear myself. So for example, if you have a house and say, okay, the first 20,000 I can bear myself, if anything minor happens, I pay it by myself, so the premium will be lower of the insurance I get. And then there is also the possibility to just say, okay, I'm willing to take on the risk, and if it goes down, it goes down. If it goes up, I will have all the rewards to myself too. So that's also a possibility, which mostly comes with certain volatility, which you all just have to be aware of. But again, if you have enough time, it can make sense. So if you have an index, you're investing like the S&P 500, NASDAQ, or the MSCI World, or whatever, it goes down when an event happened like the coronavirus and the crash in March 2020, but you will also have the full recovery afterwards.
Yeah, I think that's good. I think whenever I think about risk management, I think about the analogy of driving a car. A a lot of people get in their car every day and they drive, and that's taking on a huge risk.
Mm-hmm.
So what are the things that you do to manage that risk of sitting in a car and driving? You put your seatbelt on, you check your mirrors, you follow the speed limit, you don't drive on the other side of the road. And in investing, I think it's very similar. Are you doing your research?
Yeah.
Are you talking to professionals? Are you aware of what the market's going on? Are you aware of the risks of inflation that eat at everything, even if you have a bond? And you have, let's say, 3% return on that bond and interest, and the value, but you have 6% inflation. Yeah. Well, the bond might look like it's performing well, but in reality, systematic risk is destroying your wealth to a certain extent.
And I think one huge part of risk that a lot of people are not thinking about is yourself, your own emotions. I think that's a huge part that people should not neglect. Mm-hmm. You need to keep your head cool, you need to keep your emotions under control, and that can be very hard, especially when you're managing your own money, when you are stressed out, when you are, especially if you're retired, you don't have the opportunity to make up the lost money through generating income, like for example someone that is in their 40s. So there's also a variety of ways how you can do that. I think first being aware of that risk factor is very big, because everyone has emotions, especially when it comes to money. That's normal. That's nothing like to be ashamed of or to be, angry about, but it is something that you need to think about how you can manage it. Some people say, well, I'm only going to look at my portfolio once a quarter instead of every day. Some people say, like, I don't want to be involved in the management at all. I want to outsource that to an external asset manager or a bank or whatever. Then there's other people who say, okay, I want to do it myself, but I need some advisory. So every trade I make, I will discuss with a professional. There's a variety of factors on how you can do it, but it's just important that you think about how much do your emotions affect your trading, and what are the best strategies for you to mitigate that risk as well.
Yeah, I think it's a very good point.
Yeah, and I think in addition, it is important that you really try to understand what you do and what you invest in, so that you don't take on any investments you do not really understand, because then again you take on some risk which comes from yourself mostly, because you do something which might have or be affected in ways you are not aware of, and that can lead to losses. And since you're not aware of and don't understand it, it leads pretty likely to frustration, which at the end leads to losses again. So just try to keep it as simple as possible to really understand what you're doing. And if you think you do not understand it, that you try to get help from wherever possible. I mean, it can be as easy as Googling. You don't have to always just directly get in contact with a professional who you have to pay, but you have to be sure that you did whatever you could before taking on an investment.
Yeah, and I think to add on that, another thing is, or another risk is to just blindly follow whatever like your friend or your cousin or your dentist recommends you. But that's something that we saw extremely strongly with young people and the whole meme stock thing that started during the pandemic. Of course, you should talk to people and exchange ideas and have discussion. I think that's extremely valuable, especially if you enjoy investing. I mean, you want to share that interest and passion with other people. But just because someone has made an investment and is extremely convinced about it, it doesn't mean that it is a good investment. And also it might be a good investment for them, but not necessarily for you, because you might be in a different financial position, you might be in a different personal situation, whatever it may be. So do talk with people, do exchange views, but think about how educated they are on the topic, what makes their opinion worth following, and also think about how your financial or personal situation or your investment goals might differ from that person. Not to say that you should never do what like someone else is recommending to you, but really be critical about investment advice you're getting from anyone, but especially from people who are not in that field professionally, and check for yourself whether or not this investment is good, and if it is good, whether or not it is suitable for you. And one last point, and I know it's not very closely related, but I think it still falls into the same topics somewhat, is share your knowledge about finances and investing, and share your strategy with your family, so with people in your household, be that a spouse, be that your children or siblings, to make sure that if you, for whatever reason, are not capable of taking care of your finances anymore, that they can take over in a way that is that how you have wanted it or imagined it. And also, if something were to happen to you more drastically, that they know what your idea and philosophy behind it was, because that's also a risk that you set up everything very nicely and you have a great strategy, and then something happens to you, and whoever is now responsible for the money doesn't really know what to do, and has a huge risk of losing it very quickly if they don't have the resources and the knowledge and the strategy in place that you had. So if you put in the time and effort to put together a stable and good portfolio, if you put in the effort and time to learn about investing, and do it for many years, then make sure that you share that knowledge with the people who are closest to you, that they understand what you are doing, and that they can take over if the need ever arises.
All right, so Jamie, maybe quickly you can cover kind of the professional investors versus individual investors, and we've talked about this throughout the whole episode a little bit. But maybe you can just quickly wrap it up, kind of the differences of how risk management is used and how it can be seen in those lights.
Yeah, I agree. I think we have already covered quite a lot, and I spoke for a long time, I feel. So I will keep it very short. I think the main difference is for professional investors that they can keep the emotions really out. They can be more objective. And of course, it's also a question of how much time can you invest, right? So for professional investors, that's what they do all day, 8 hours a day, more often than not, much more than 8 hours a day. And they have the systems and tools in place to really analyze the data, to get company data before it is published or written about in the newspaper. They have the opportunity to set stop losses and trailing stop losses. They usually have large enough sums that they can really diversify. Also, I think there's this group knowledge, that there's usually an investment committee of several people that make decisions on a portfolio. In my opinion, that also makes the decision stronger, because every idea has to be discussed, and you need to convince the majority of the investment committee to agree with you, whether it's buying something or selling something. So I think that makes the decision stronger than just one person doing it. And then there's really just, I know I said it before, but there's really just the looking at the data and the investments and the portfolios on an extremely regular basis, but without the emotional component of this went down 0.1% today, should I be worried? Because there's experience and knowledge that has built up over years and decades that helps keep the head cooler and be less moved by, I would say, the masses or emotions.
Thanks again for joining us on this episode of the WHVP podcast. If you have any questions or would like to discuss with us further on this topic, please give us an email at info@whvp.ch. If you're interested more in our company and what we do at WHVP, check us out at our website at www.whvp.ch. Or you can check us out at any of our social media handles on YouTube, Facebook, LinkedIn, or Instagram by simply searching WHVP. Have a great rest of your day.